Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is June 24th of 2024, the last week of the month, the last week of the first half of the year. And crazy to think how fast that first half of the year has gone. So far, when we look across our growth sleeves, up double digits after fees across the board there. So we're happy with the results there. And most importantly, we've been able to do it without chasing the speculative corner of the market, which happens to be the very top of the market, which happens to be those largest 6 to 7 stocks that have been dominating performance year to date. Now, there's a reason why we're saying that, right? Is they are fantastic companies, they're high quality companies, cash rich, but the valuations right now are not just extreme, but the positioning within Wall Street has become extreme. So this week, we're going to focus on what we're calling that magnificent bubble, how leadership at the very top of the market has become narrow and within an important group of stocks, right? So when we look at the S&P 500 performance and what's driving that S&P 500 performance, it is increasingly reliant on 5 to 7 stocks. And we think that's where the danger is right now. Now, we have been invested outside of that, and we've been able to generate performance outside of that. So when we look at that S&P 500 equal weight, it's in the low single digits year to date. So the S&P 500 equal weight S&P 500 is up only low single digits year to date. Same with the Dow. Despite that high concentration, we've still been able to generate double-digit performance. We're really happy with that because we think in the back half of the year, we believe, based on our work, that that will accelerate. So 3 big things for this year this week is that we're seeing worsening concentration within the benchmarks as investors continue to chase technology returns. We believe that most stocks on the NYSE are in a corrective phase off the top, right? So when we look at the average stock outside of the 6 or 7 magnificent 7 stocks, most are in a corrective phase right now. We're going to go through that. Lastly, the U.S. economy appears to be entering late cycle slowing growth, while many emerging market economies are actually entering what we call that early stage recovery. So we're seeing cycle divergence across the world where US and some developed markets are slowing down while emerging markets are starting to reaccelerate off a recessionary phase. So that should be indicative of how we want to look at asset allocation, areas that are heated, areas that are not as heated. How can we create alpha in that type of market rotation? We look at the S&P 500 right now. We came from a purely technical standpoint, we came out of this consolidation phase where we broke away from that 52.65 March high. 55.75 is that implied target from a technical perspective, quickly approaching that, while a lot of the market is very, very, very overbought. So that's the risk right now. We're close to these technical targets in a very overbought condition. Obviously, when we look at the triple Qs, the NASDAQ, more extreme, right? So we look at that overbought, oversold condition, very overbought. And we've already reached that 485 implied target from a technical perspective. So again, coming out of that consolidation, measuring the length of the consolidation to get us to a implied breakout target of 485. We're there, right? At a very extreme overbought condition. So from a trading perspective, we would think, or we would look at these conditions and say, you know what, time to take some money off the table if you're in these triple Qs, if you're in the market cap weighted S&P 500. Again, I wanted to paint a picture of what that narrow leadership at the very top looks like. So when we look at ETF flows, so in other words, investor money going into the market, most sector flows over the last few weeks, when you look at the trailing 1 year versus 20-day, is negative, right? Or slightly positive. Where with all the flows remain in one sector, technology. So When we look at an investor flow perspective here, almost all of the inflows are being gobbled up by one sector, which is technology. Every other sector has become a source of capital to feed the appetite into tech. These types of conditions are not sustainable. At some point, you see tech revert to where everyone else is, or money flows back into these other sectors from technology. So our job today and tomorrow and yesterday is to really try to understand, are we at the last innings of the overall bull market, or are we about to go into some sort of leadership change at the very top of the market? One thing I would also note is that lots of strategists are trying to chase that S&P 500 target and ratchet those targets higher. We see Ned Davis, Cantor, Citi, Evercore, Goldman, BCA, Stifel, CFRA, which is out of Asia. All these strategists since June 10th have upped their price targets. Again, this is very indicative of a chase, right? So we want to be really careful as investors to say, okay, you know what? Everyone is piling in. We're long, we're making money. Let's not get greedy. Let's take a little bit off the table here. And again, the other thing to look at is S&P 500 record high, but the NYSE advancing stocks as a percentage of the total is actually pretty low. So when we look at the 10-day average, the percentage of NYSE stocks that are advancing has started to drop. That's a very rare condition where you see the S&P 500 hitting a record high, but the percentage of advancing stocks continues to fall. That is indicative of poor breadth, right? Now, poor breadth is not a death sentence for the bull market, and that's not what we're saying. And you'll see what our conclusions are later. But it can be indicative of a trading top, right? So when we're looking at index exposure, we would certainly say, you know what, let's back off the S&P 500 and put money elsewhere. From a longer term trend perspective, the market actually looks pretty healthy. So we look at the percentage of stocks in positive trends, so above the 200-day moving average, we're actually in a very wide participating market, right? So most sectors are in that, if not all sectors are in a what we call a positive long-term trend. So again, looking back here, negative short-term momentum with a lot of these stocks selling off outside of technology, but long-term trend-wise, they're in good shape. So do we want to buy the dip over here, or do we want to chase the rally up here into the right in technology? I would argue, based on the evidence here, where the average stock is oversold versus technology overbought, that we actually want to buy the dip in a lot of these sectors with strong trends, but oversold short-term conditions. Let me just go over here to the next slide. So we're going to go through a series of charts to kind of, again, illustrate the concentration at the very top and how it's misleading the average investor to not see the actual weakness that has been taking place. So this is the S&P 500 to the left. This is your S&P 500 equal weight, right? So the S&P 500 on the left here is very concentrated with the stocks of NVIDIA, Apple, Microsoft, Amazon, Meta, Tesla, etc. They make up almost just under half of the overall market, right? So like, again, very impacted by a small handful group of stocks. When we look at the equal weight, we're in a corrective phase in the market right now, right? The peak was actually reached in late March, and we're actually down from late March levels versus the S&P 500 that has strongly broken out to record highs. So again, interesting divergence. Now, are we seeing consistency of those divergences across the board? This is the S&P 500 again, cap weighted, versus your average stock on the New York Stock Exchange. What's the difference between the equal weight here and the NYSE? Just more stocks. So the NYSE composite includes all stocks across all indices that trade on the New York Stock Exchange. Again, The peak here was reached in late April, early May. We're down from those levels. So again, we're in a corrective phase for the average stock on the New York Stock Exchange versus just 4 or 5 stocks pulling the rest of the index up on the S&P 500. Same thing here. We look at the S&P 500 cap weight versus the Russell 2000. Russell 2000 in a corrective phase versus the S&P 500 that is being led by just, again, 4 or 5 stocks. Same here, cap weight S&P 500 versus the Dow Jones. This is an interesting one because the Dow Jones is all composed of very large cap companies. The difference, though, is that the Dow does not have NVIDIA. The Dow does not have other large cap growths like Tesla in there. So what you see is, again, that divergence. Dow in that corrective phase versus S&P 500 rocketing to new highs. When we look at style divergence, growth versus value. Growth, again, being pulled up by the Metas and the NVIDIAs of the world. Value being pulled down by all the other stocks that are in a corrective phase. Value is actually down year to date. So that's an interesting note. So again, we look at our own growth sleeves right now. We see that those growth sleeves are up double digits without that bubble exposure. So we're really happy in terms of how those portfolios are positioned. So what are a lot of these key takeaways that we want investors to focus on? Narrow leadership can suggest a couple of things, right? That the stock market is running out on fumes, right? So in other words, that overall rally, the number of soldiers that have fallen continues to pile up. The market is being inched along or advanced forward by just a handful of stocks that at some point exhaust themselves out and the entire market falls back. That's one option. Number two, leadership becomes exhausted, right? The very top of the market gets exhausted as they start to pull back. Money merely finds a new home with the rest of the market, and we see a leadership rotation out of technology and into other areas, whether it's emerging markets or consumer staples or consumer discretionary, etc. We see that rotation, or it's a precursor to an everything rally, right? So in other words, new money comes into the market from the sidelines, whether it's the bond market or the money market or cash, and pushes everything up. Our evidence suggests that it's not the first one and it's not the last one. It's probably this middle one where leadership becomes exhausted and we see a rotation into other areas of the market that are cheap, that are experiencing really attractive growth rates. So what's that balance of evidence? Momentum is weak right now for the average stock, but the trends are strong. When you see that type of setup, you usually want to buy the dip, right? So where are we seeing buying the dip right now? Everything outside of technology, right? So technology, strong momentum, strong trend, but very, very overbought and showing lots of evidence of a potential bubble. So that's not really a chase the high or buy the dip scenario. Everything else, strong trend, but very weak momentum as things have pulled back underneath the hood. That looks like a buy the dip moment. What leads us to believe that? Consumer discretionary stocks have actually been outperforming consumer staple stocks. That usually doesn't happen ahead of a bear market or of a recession. So consumer discretionary and credit in the credit markets remain intact, right? So credit remains strong. Consumer discretionary stocks are acting well. That's usually indicative of a solid macro backdrop to support risk. Third, the average stock is oversold, but leadership is overbought. So that overbought condition is not pervasive across the entire market. It's hyper concentrated in 4 to 6 stocks. Outside of that, the average stock is actually de-risked quite attractively. So we would prefer to be buying that average stock. So balance of evidence, market rotation this is what we expect, is a market rotation of those expensive large cap tech stocks and into some of the cheaper areas with attractive growth profiles. What do we prefer? We prefer areas such as the emerging markets. We prefer some orphan growth areas that have not participated in that growth rally year to date. And then, of course, other areas such as commodities that remain attractive. So that's what we got for you this week. 888-543-3776. Please feel free, pardon me, to reach out to your advisor, to the home office, and we're certainly glad to help. And have an absolutely fun week. Talk to you soon.